Hello, everybody. We are now live. My name is Christian Cavarelli, and I'm super excited today to have Jason Garcia with me. He has a background in finance. He has also participated in several startups. So he really can see both sides of what's happening when it comes to startup financing and understands deeply the entrepreneurship path as well. He is the entrepreneur in residence at Indie.VC and one of the founding forces behind Intro.me, which is all about alternative financing mechanisms. Jason, thank you so much for joining us today. I'm so excited to chat with you.
Yeah, thanks for having me.
Absolutely. So why don't we jump straight into it? I think what we're trying to talk about a little bit here is venture capital is not the only way to go. There's definitely a big space in that market, but there are alternative ways of raising capital and getting growth capital. Indie.VC, why don't you tell us a little bit what that's about? And then tell us about this super exciting release that happened about 6 months ago, which is Intro.me. I know it's been getting a lot of traction. I've been following it and being super excited. Why don't you bring us through that a bit?
Yeah. So Indie's got, a pretty long history. It used to be called, the predecessor to Indie used to be called OATV, O'Reilly Alpha Tech Ventures. Bryce was a co-founder there, Bryce Roberts. He's fairly active on Twitter. A lot of people may know him from there. But he's had a really long career and really large successes in being a venture investor. One of the first kind of traditional seed investors in the market. And that firm I think started about 15 years ago. And through the genesis of what happened in seed, he saw massive influx in VC that wasn't really there before. When they first started doing seed, there was only a few players. So there was a lot of opportunity and a lot of companies that were really interested in using that type of financing. And then he's seen over the years that market's become a lot more saturated and started building out Indie, which is a new way of a new type of financing for startups that is maybe a little bit more ownership friendly and founder friendly than kind of traditional venture has become. Let's see.
Nice.
I've got an announcement, I guess, in here in the background. So Indie kind of grew out of this massive growth in VC and seed, and said there's got to be something different. And founders have been asking for something different, right? They've been asking for, more ownership, more control, a better way of financing their business that doesn't, make them give away a lot of what they're building. And so Bryce started tinkering with a new type of financial product, and that's basically what Indie.VC's become, which is, it's become a financing vehicle for companies, but it also allows them to purchase back the equity at some portion of time, so they can decrease dilution and become more of like a bootstrap type company. So that's Indie. And Bryce and I have known each other for 7 years or so. When I first joined in the kind of startup ecosystem, I joined Silicon Valley Bank and helped run their office here in Utah, and was did about 300 million in venture debt type investing. And then after that, joined and jumped into a couple of startups. And Bryce and I have kind of stayed in touch and talked about the different problems in the financing market and continue to kind of discover opportunities, which led us to Intro. So Intro, Bryce from his side of the coin was seeing that seed is oversaturated, but then also Indie.VC is only one flavor of capital to really solve this problem, right? And there's a bunch of different other types of capital, things that are built specific for industries like SaaS lending or D2C lending and those types of things. And so he saw that, wow, there's all these products that are growing like Indie, and Indie's been kind of the front runner in that space and try to be a thought leader in that space. But all the other players are, and this market's relatively unknown. So there's got to be a way of kind of getting that word out and letting entrepreneurs tap into that capital easier. And I saw the same thing at SVB. I was always surprised that there was two kind of big shocking things for me. One, venture debt in a lot of rounds is the largest portion of capital, but it doesn't make it into the press releases, right? And so a lot of people don't understand that like debt is actually a pretty large force behind growing businesses, even in VC. But it's kind of this unspoken, thing that's there. Then number two is that like I would meet a lot of companies that were, financing inventory or those repeatable parts of their business, but they were raising VC to do that, which is the highest cost of capital to finance something that's very short term and pays back right quickly. So, so we started kind of discussing these problems that like, wow, there's a financial literacy issue, which is they're just not aware of it, and it might be intimidating to them because they're not a CFO and they might not have a CFO. Mm-hmm. And so that's what really kind of started Intro was we've got to tackle this problem, help people tap into this capital base a lot easier. And so Intro, we built this platform that allows entrepreneurs to create a profile, and based off their business data, it visualizes and helps them see what funding options are available to them. So if I'm a inventory-based business, here's some inventory financing, and it only becomes available when you're at the scale that it actually makes sense to be able to tap into that capital. And then in the platform, you can ask for connections, and then we will actually connect you with financiers. So
yeah, that's amazing. I think that's really cool. You've pretty much nailed it in saying that like a really big part of this is education, right? It is to get people shifting from a mindset that they've read, let's say, in the news. And as you mentioned, a lot of debt financing is not in the news. I think that there's a lot of misunderstanding when it comes to both financing options and the way that you should actually build startups, just by the narratives that are really kept by mainstream media around these success stories, which are oversimplified and maybe. And I think that like the first step is really educating people, so that we don't have just generations and generations of entrepreneurs who are all looking for VC funding when oftentimes it doesn't line up with their goals. And I think that over time, there's going to be a big shift. And I think that what you guys are doing at Indie.VC, I remember one quote that I'd read that really kind of resonated with me. It's like, I think you guys wrote something like, we're trying to write your last check. And that's like very contrarian when we talk about the way that sort of the venture capital model works, which is, you raise a first round so you can raise a Series A, Series B, like C, D, and then you exit, right? And I think that, as companies are able to get into revenue quicker, like it just makes sense that the mechanisms would change. Like, how are you seeing, because obviously revenue generating basically starts bringing you closer towards being eligible to get a loan from a bank, right? Mm-hmm. So where would you say that gap really lies between like VC and then like, and then sort of, what are you seeing the most, let's say, the most interesting mechanisms that you're seeing? Are those like, obviously grants, probably one of the things. What are all these different tools, and which would you say are most eligible for startups?
Yeah. So starting on the bank end, most banks are really looking for profitability, and so most companies that are growing fast, trying to reinvest to either hire or build their tech, doesn't have that profitability yet, and that's okay. And so you shouldn't have to sacrifice your growth per se to obtain capital for a loan, and that loan ultimately requires you to be profitable, and so you won't have that growth anyway. So it doesn't really fit, right? So if you're not profitable, traditional bank financing is a lot harder to tap into. And then the people that kind of the banks, venture banks, and I used to work at one, and they're great. They really kind of follow on to VC investors. So unless you're profitable or unless you're raising a larger round, and typically you need to raise at least about $3 million in VC funding from a firm, not from angels, but from an actual VC firm, then you can tap into venture debt. So if you don't have those two criteria points, then you're kind of left with all the alternatives. And on the way far left side, you've got VC, which is super flexible, but really expensive, permanent capital sitting on your cap table until you exit. And that is really, really good. Our view is that that capital can be really good when you're kind of pre-product, pre-revenue to get that engine going if you need to, or world domination. I need a ton of capital. I'm going to do some crazy, growth things here. I'm going to be wildly unprofitable. I'm going to reinvest everything I possibly can to grow as fast as I possibly can.
Blitz growth strategy, basically.
Yeah. So if you're on that side, then VC can work, and obviously the market's got to be big enough, and the product's got to be ready for the market in order to kind of take advantage of that. So that's where that fits. So there's this really broad range of like profitable company, and then the blitz scale company that can grow 300% year over year for the next 5 years. And like most companies probably sit in between those. And so really what we say for intro is we fit really well for companies that have done about 10,000 in revenue or more, and that are living in the US or Canada, that we've been able to build. We have about 28 partners, I believe, now on the platform. It's about $1.5 billion in total funding capacity. That's, that is there to support those types of businesses that sit in between. So you don't have to be profitable. I think that's one thing that I think is a misconception is, in order to tap into debt or alternative financing, I need to be profitable. You need revenue, and you need to be confident that you're going to be able to pay it back. So is the engine of your business working? Did you just make 10,000 a month, or have you done 10,000 a month in 2 or 3 months now consecutively, and have been able to show that there is a business here, and that I've got enough revenue to kind of pay back that capital? If you've got that, then that's what we're kind of built for. Repeatable business, 10,000 in revenue or more, sitting in North America.
I love that. I love that because it really encourages this sort of middle class of startup. It's like saying like, let's build 10, 20, $30 million companies instead of being sort of always obsessed about this $1 billion exit or nothing, right? I think it's a little bit like it's putting people in a position where there's a lot of failure, and I think there doesn't have to be, right? There has to, specifically now that we're talking about like a lot of these companies, like we're literally just talking about small medium businesses, small medium enterprise. It's like this is just these are just funding mechanisms that now that companies are becoming increasingly digital. All these business models are more scalable. And so the thirst for capital is also in part to fuel that growth, right? But you don't have to, as you said, like give up everything or have to build $1 billion company or die trying. What's interesting about what you mentioned is that, high risk capital like VC money, is kind of, is something like for early on, right? To fuel the early on, but unfortunately, when we look at a lot of those markets, they're increasingly like investing in companies that do have revenue, right? You look at like the seed deals there was like this thing, and it was like they looked at like 4,700 deals, and it was like it was just very clear that like between 2010, like 10% of the deals were going to companies that had revenue. And like 7 years later, 2017, that number was already at 50%. So now we're looking at like basically 75% of deals are probably going towards companies that have revenue. Mm-hmm. And so it's an interesting thing. It's almost saying like VC is no longer there for the for what they used to do. That market has matured as well. Like, how do you see that, and how do you think this will, people like Indie.VC stepping in and these alternative financing mechanisms, how do you think that's going to sort of change VC, or what should VCs be thinking about?
Yeah, I mean, so there's a lot of capital in the market, right? And so we see this a lot in the regions where companies and VCs are investing in companies that are post-revenue. And if you look at like the revenue per company at a Series A relative to the revenue per company Series A in the Bay Area, is crazy. Like you have to have way more revenue here to be able to kind of earn into that. And the challenge, like the reason why, is because capital's not as readily available. And a VC can either invest in a company that's doing $1 million in revenue or a company that's doing $5 million in revenue, because the founder feels like it doesn't have other options. then they opt for that, VC capital at a similar valuation as the company is doing $1 million in revenue. So there's, again, I think some of it is knowing what's out there and knowing that that's not your only option at that scale. I think two, VCs are trying to deploy the capital that they've raised. It's the job, and not everyone's going to get into the Zoom, right? It's hard type deal, or Clubhouse, I guess now. So whatever the hot deal is, not every firm can get in, and so they're looking for other types of investments to earn their money back. I think the challenge is, and VCs and I think founders are also seeing this, which is, if you raise 5 million in venture and your company grows and it's a competitive market, or the market's not as big as you thought it was, and it sells for 100 million, it's not a great outcome. It sells for 40 million, it's not a great outcome. For a company that is able to take, $500,000 to $1 million and kind of bootstrap to the same level of scale, may take a little bit longer, it may take a little leaner team, but by owning, 75% of your $40 million exit versus, most founders own less than 50% at a Series A. So if you own 40% at a $40 million exit, those are two very different outcomes. And so the total
not to mention the liquidation preferences that you might have signed along the way.
Exactly. And so the total dollar, exit may be lower than that $1 billion exit, but your total cash out as a founder and what you've actually earned from that hard work and blood, sweat, and tears to build that company is much higher. As I think a lot of founders are starting to figure that out. And I think founders are now looking at all these historical companies as well. All the big brands and the big box stores, you look at them and you say, these guys didn't raise VC. I think there's a challenging of convention of how are these companies growing so quickly without having to raise VC. There's got to be a better way. The mattress war that happened years back, I think also brought light to that. Casper raised a ton of money. And
the mattress war, what was this? I didn't follow that story.
Well, so mattresses, that mattress market, mattress in a box, I'm going to order it, it's going to come to my house. Yep. You had Casper, which was really, really large. They raised a ton of money, and they had a cool brand. And then you got Purple, which is down the road here. And I knew those, I followed those, knew those guys at like month 2. And by month 2, they were already hitting profitability. And they're, you look at Tuft & Needle, a lot of those guys were doing about the same level of scale as Casper pretty quickly, but they had never raised money. And so I think that, stories like that help us realize, wow, there's a way to still grow and get to scale, real scale. I don't have to raise a $5 million Series A to reach scale. Now, some companies do, really highly technical companies that like we've got computer vision, like scientific labs here in Utah. Probably can't do that type of tech, unless you have, real engineers building something. But in most cases now, especially software, SMB, B2B software, there's a lot of ways. No code is one tool you can use that's very, cost effective to build out a product. You don't need to raise a $2 million seed round to build a kind of simple solution. It's not going to be a finely polished product, but I think most people would argue you don't need that to get in market. So real quick, like one of the companies I was at, I was brought in to kind of help turn some things around. They raised a bunch of money from Silicon Valley investors, and it's kind of that classic playbook of like, we're not going to release to the market until it's ready, and we're going to have this fully baked enterprise grade solution. And you just don't need that in most cases to get out, test it. So using tools like no code and other things that are cheaper, and challenging your thoughts of, do I need that 5 million slug of equity, or really can 500K to $1 million, help me get to that next milestone? Yeah,
absolutely. And I think that it's like kind of this, it comes also, you see much more people, like a lot of people who we actually train and teach, all the no code shops to. These are people who have actually gone through it a first time and realized like what it really means to be a first time founder. And a lot of times, like first time founders don't really know what they don't know. And that's a problem both with building the product and building your company, and also with these funding mechanisms, I think, where it's like, it's difficult to tell someone like what they're about to embark on has a high likelihood of not being the right path. You know, it's also like, it's an interesting thing, but sometimes humans just have to learn from their own mistakes, you know?
Yep.
Cool. So first question, have you guys already sort of funded a company that is built fully with no code?
Yes. Yeah, we have. I mean, Bubble.
Awesome.
Yeah, we've got a company that's running most of their stack on Bubble.
Nice.
I'd say, you know, we've got a healthy mix of software and D2C type brands. And so I don't know what the mix would be in the software side, but yes, we've got a company that runs most of their business off Bubble.
Yeah, no, it's interesting. I think that there's going to be a lot more of these kind of things. Let's move back to kind of talking about this whole thing about funding. And I think one of the things on the investor side is this idea of, okay, you need to have a liquidity event, right? So in these VCs, you have mechanisms where basically you are inflating the price of the company, the valuation, and you are multiplying the value of the investment that you've put into those companies. And then when there's an exit, or if someone chooses to sell at one of the rounds, they get that liquidity event. When we talk about alternative financing, specifically towards kind of Indie.VC models, what do those liquidity events look like? Like, what are the terms? Like, what is the structure of the deal look like? So I'm just trying to get the audience to understand a little bit better, you know, these mechanisms.
Yeah. So, and you're just specifically talking on the structure of our type of financing, not necessarily like the actual liquidity event financing.
Yes, exactly. It's just like the model and how you actually make money, basically.
So Indie. So I'll talk Indie, and then I'll kind of talk broadly on intro. So Indie, we invest in a convertible note type structure. It's a safe type structure, and so we are taking a portion of your equity. It's just a much smaller portion than you normally would have if you decide to kind of go down that other path of paying back some of the capital, right? So you can purchase some of your ownership back from us, and if you do that, then you're decreasing the total amount of ownership that we might have. But it's still ownership. So we, you know, and if they decide to go raise traditional VC, then we would convert just like traditional VC. So it's not so much different in terms of how that would be structured. We don't create our own share class. We ride along with whoever is creating that new share class. So so that would be, you know, that's on the Indie side. On the other side of it, with intro, none of our partners in intro take any equity. So ideally, what would happen is you take capital, you're paying that capital back as you're growing, right? And so then the capital is paid off, and when you exit, then there's nothing. You know, there's no, once you pay back that capital to our partner, there is no obligation to pay them anything because they're not taking any equity, they're not taking any warrants, they're not taking any options, nothing, none of that. If you have something outstanding, typically what happens, like if I took a $2 million loan, let's say a revenue-based financing loan from one of our partners in intro, and I had $1 million still outstanding, I hadn't paid back that $1 million yet. Typically what happens is the acquired entity would actually take that loan on, or they just pay it off. Like if they've got the cash, they would just pay it off, and then that partner goes away and it's done. Or they take it on and they just service it and pay it off at the normal kind of pace. The deal doesn't necessarily change based on the liquidity event. It's still the same structure. It doesn't increase reward for them. There's none of that type of stuff. The only place, and we don't have one of these partners in our platform because it's a little bit, I wouldn't say hard money is the right word, but it's a little bit more expensive as kind of those larger late stage kind of bridge type investors that are doing some form of mezzanine where there's a success fee. Whereas if you exit during that period of time, then they might get a kind of a pop or a large fee. But we don't have any of that in intro. That's the only other thing I can think of, an alternative that might change that liquidity.
No, that's super cool. So where do you see all of this going? Like there are so many things happening at the moment. The world's kind of crazy place, but when we just talk about this industry as a whole and the financing industry, like what do you think this is going to look like in 10 years? Is everyone going to have kind of a different place in the market? Like, maybe companies, VC will be reserved for companies that are doing very cutting edge stuff that requires a lot of money early on. How do you see this kind of play out over the next 10 years?
Yeah, so I think that there's going to be a convergence with startups and kind of traditional finance, which is that your financial products are built around doing a certain job in your business, right? And using like a couple examples, a traditional business or a really large corporate, you've got your credit cards that you're using for T&E spend, your travel and entertainment spend, book your flights and those types of things. And they may have a line of credit to finance inventory, and then they might raise money in a secondary offering in an IP, like something as a public company for additional growth in their business, right? And so they've got these specific financial products to do specific jobs. And I think we're starting to see that now in startups a little bit, but it's very early days. You've got, people now that are like Brex, and Gibby and Ramp that they've all built credit cards specifically that will help serve startups. And those startups haven't been able to tap into those really well in the past. And so now you've got a credit card to tackle all the T&E spend in startups. So I think we're going to continue to see an evolution of financial products to do different jobs inside of a startup that are willing to take the same level of risk as a startup. And rather than somebody raising a $5 million large slug of equity, I think what they'll do is they'll raise a more modest amount of equity for their business that is specifically going towards offsetting losses, and maybe buying certain talent ahead of time. And then they're going to be using debt and credit cards and other types of financial products to help shore up the rest of that capital that they might have used in equity. So rather than using the hammer of equity and funding everything, they're using 5 different financial products to kind of help support the operations of their business.
Wow, I love that. I really, really like that idea that like you can use different sources of capital for different use cases. Brex is an amazing company. I think they've done a really great job. I think that what that is really like, we've shifted, right? There's been this shift and the financial market was not really ready for for basically the Silicon Valley style of startups where there's not necessarily too much proof of concept, and already we're talking about valuations of 5-10 million. Mm-hmm. So it was clear that the market was going to have to adjust to that a little bit. No, that's amazing. So before we finish this interview, I wanted to ask you a couple of things. First of all, where can people find you if they want to reach out to you, if they want to learn more? I would like to personally say that I think every single person listening should go and sign up for Intro.me. They also have a newsletter that is called
Intro to Finance.
Intro to Finance. That's going to give you just amazing tips on kind of just, it's just a weekly thing. You'll get a digest. You'll start learning more. And then once you're ready, you can jump into Intro.me. But so where can people find you?
Yeah, so Intro.me is the URL. They can find us there and build out their own profile. If you have any questions or you want to reach out and connect on a personal basis, I'm always happy to. LinkedIn, happy to take messages, or Twitter. I'm maybe a little bit more active on Twitter. And my handle there is Sir Jarg, SIRJRG. And reach out anytime. And then Indie.VC, we'll be opening up our application here in the fall. And so applications should go live here in the next couple of weeks. And that URL is just Indie.VC in my name here on the screen.
Very cool. So as kind of a parting question, I'm going to ask you maybe the heaviest question that someone can ask. What kind of influence are you looking to make within this space? Yeah,
I appreciate the heads up because I had to think about this for a sec. But I think for me, I mean, what we're trying to do, Intro to Finance has been really fun to do because I'm kind of taking a lot of the knowledge that I've taken from being in traditional finance and then being in startups and seeing both sides and kind of the disconnect. I really want to help founders understand the power and strategic power of finance, and not that it's just accounting or QuickBooks, but it can actually help make a difference in how you grow your business or how you run your business. And doing things a certain way can have a larger impact than you might otherwise think. And so I think helping founders understand finance is not as intimidating, and it actually can be really helpful to the business.
I love that. And maybe I'll also add that, like, you don't have to be good at math, because a lot of people have that excuse, right?
Yeah.
Like, I'm not good at math. I can't. This is not about math necessarily. Calculators are out there.
Yep.
But yeah. So Jason, honestly, I think that what you guys are doing is tremendous. I'm so excited to see the influence that you guys are going to have over the next couple of years. Again, everyone should go sign up for the newsletter and join intro.me. You know, this is something where, again, it's about empowering yourself and making the right decisions at the right time. And a big part of that when you're growing a tech startup is with regard to financing. So Jason, thanks so much for taking the time to speak to us. Thank you to the audience who's watching. And I wish you all an amazing Wednesday. Take care.